The tax consolidation regime is very literal. Membership interests such as shares in a subsidiary are ignored for income tax purposes. Instead, the tax costs of the assets brought to the group are set according to the cost setting rules. When an entity joins the group, the head company is treated as owning the assets and liabilities and history of the business of the subsidiary. The tax costs of the assets are set to reflect the cost to the group of all membership interests in the joining entity. On the 1st of July, Baxter Limited purchases all the issued shares in Moonsun Limited for $200 and chooses to consolidate. To calculate the allocable cost amount, or ACA, we start with step 1, which is the cost of the membership interests. When we consolidate for tax purposes, the membership interests in the subsidiary cease to be recognised. Instead, the cost is now attributed to the assets of the subsidiary, now being treated as held by the head company. So in this case, the cost of the shares is $200, and this forms step 1 of the ACA. For step 2, we need to add the liabilities of the subsidiary at the joining time. In this case, the $100 loan. Therefore, the ACA is $300. In this case, consolidation has occurred immediately on the 100% share purchase, and therefore there are no group retained profits or distributions of the subsidiary to be accounted for in steps 3 and 4. Let's consider if instead of immediate consolidation, Baxter Limited does not consolidate until the 1st of July in year 2. During the period from acquisition until consolidation, Moonsun as the subsidiary paid a dividend of $100 from pre-acquisition profits, and after-tax trading retained profits of $200 were generated. So we still have the $200 cost of the shares for step 1 and the $100 loan for step 2. But now we need to add the undistributed accrued frankable profits of $200 at step 3 and deduct the distribution paid from pre-acquisition profits of $100 at step 4. This gives an ACA of $400. Now, we would also need to consider for step 5 any unused losses accrued to the group. That is, unused tax losses of the subsidiary that occurred after acquisition but prior to consolidation. With respect to any carry-forward tax losses that the subsidiary may have had prior to acquisition, then the tax benefit of those losses is subtracted at step 6. Finally, we must also consider whether there are any inherited unclaimed deductions sitting in the subsidiary that the group will benefit from in the future. For example, borrowing costs, which are deductible over 5 years. So, for any deductions that are accrued deductions, being those incurred post-acquisition but prior to consolidation, then we subtract the full amount. For any acquired deductions, those existing within the subsidiary prior to acquisition, then we subtract just the future tax benefit. Once all 7 steps have been considered, then you will have the allocable cost amount for the subsidiary on consolidation.